Welcome to The Explainer. Today, we're diving deep into the latest numbers from one of India's banking giants, ICICI Bank. We're going to look at how this huge player is steering the ship through some pretty choppy economic waters. So, let's get right into it. So, here's the big question on everyone's mind. In an economy with slowing demand and some seriously intense competition, how is a bank like ICICI adapting? You know, its performance is often a pretty good indicator for the entire Indian banking sector. So, what they do? Well, it matters to everybody. All right, here's our game plan. First, we'll run through the quarterly scorecard, which honestly looks pretty strong. Then, we'll dig into the economic headwinds that are kind of hiding just beneath the surface. From there, we'll break down the bank's big strategic move and response to all this. And finally, we'll try to read the tea leaves and figure out what this all means for the future. Okay, let's kick things off with the headline numbers for the first quarter of fiscal year 26. And I gotta say, on the surface, things look incredibly solid. The bank is posting some really strong figures that show it's built on a pretty robust foundation. First up, check this out. A very healthy 15.5% growth in profit after tax compared to last year. That's the bottom line, right? It's a key sign of profitability and shows the bank is still generating really strong returns for its shareholders, even when the economy is a bit tricky. And if we look a little deeper, the core operating profit, now this is the number that cuts out any one-off stuff. It grew by a solid 13.6%. So what this tells us is that the bank's fundamental business, the day-to-day work of lending money and earning fees, is performing really, really well. So a big part of the bank's strength comes down to how it manages risk. And you can see that super clearly right here in its loan book. It's nicely diversified, no single area is overwhelmingly dominant. Retail loans make up just over half, but that's balanced out by big chunks in business and corporate lending. It's this careful mix that's absolutely crucial for keeping things stable. And that foundation looks even stronger when you check out the asset quality. The net non-performing asset ratio, which is basically a measure of bad loans, is at an exceptionally low 0.41%. That is just, wow. Pair that with a high provision coverage ratio, meaning they've got plenty of cash set aside for any potential losses, and a massive contingency buffer, and the message is loud and clear. This bank is built to withstand some serious shocks. Okay, so everything looks pretty great, right? Well, not so fast, because beneath this really strong surface, some challenges are definitely brewing. The whole economic environment is softening up a bit, and you can start to see that impact when you dig into the more detailed data. So, let's do that. This right here is a real tale of two speeds. On one hand, the year-on-year growth looks, decent. But then you look at the quarter-on-quarter numbers, what's happened just in the last 3 months, and you get a totally different story. Retail loan growth is almost flat, and even more telling, key unsecured areas like personal loans and credit cards, they actually shrink. That is a massive signal that consumer demand is slowing down. And at the same time, the bank's main profit engine, what we call the net interest margin, or NIM, well, it's feeling the pressure. Think of this as the profit margin the bank makes on its core product. And as you can see, that margin has gotten squeezed, both compared to last year and even just the last quarter. So the bottom line is, it's just getting a bit harder to make the same amount of profit on every loan. And look, the management team isn't trying to sugarcoat this. This quote from their recent earnings call says it all. They sound cautious, guarded, and that really reflects the softness they're seeing in loan demand across the board. They're basically saying, hey, we're not sure what's next either. So, what do if you're ICICI Bank and your consumer segment is slowing down while your margins are getting squeezed? What's the plan? Well, that brings us to the bank's strategic pivot, where it's actively shifting its focus to find new ways to grow. And here it is. This is the hero number of the quarter. While the retail side of things cooled off, the business banking segment, that's a part that serves small and medium businesses, grew by nearly 30%. That is huge. They're clearly shifting their weight to this high growth area to make up for the softness elsewhere. And this isn't just a one-off move. It's a whole multi-pronged strategy. The bank is counting on future interest rate cuts to get demand going again. And yeah, they're also looking to get those personal loans and credit card numbers growing again. To do that, they're really hitting it from both sides. doubling down on their digital platforms while also expanding their physical footprint. They opened 83 new branches this quarter alone, all to get deeper into these high-potential groups, like farmers and the self-employed. And of course, technology is at the absolute heart of all of this. They're building out this really powerful digital ecosystem. You've got platforms like Instabiz for businesses and tools like EasySign that just make banking simpler for everyone. The whole goal here is to make everything more efficient, to bring in more customers, and to power that push into new markets. All right, so let's pull all this together. What does this all mean for the future? Well, ICICI Bank's performance and its strategy, it gives us some really critical clues, not just for the bank itself, but for the entire Indian banking sector as it tries to figure out this new economic cycle. There are a few big lessons here that apply to pretty much every bank out there. First, managing those interest margins, that's the new battleground. Second, you can't just rely on the old ways of growing. You've got to diversify into these other high-growth areas, like lending to small businesses. Third, all that digital stuff, it's not a nice-to-have anymore. It's just the price of admission to compete. And finally, just because your loan book looks clean today, you can't get complacent. Staying vigilant is everything. And so, that leaves us with this one big, fascinating question to think about. ICICI's strategy, it's clearly cautious, it's deliberate, it's focused on managing risk. So, is this a masterclass in prudence that's going to protect the bank if things get worse? Or is it a missed opportunity to be more aggressive and grab market share while other banks are pulling back? I guess only time will tell.